For years, the pension was a smart play. Put money in, get tax relief, let it grow, and if you didn't spend it all, you pass it on to your kids. You worked hard for that money, it's your right to pass it on. Most people built their entire retirement plans around it. You secure your future and leave the rest behind for your kids. But that deal has changed. HMRC has published the official guidance on exactly what happens to your pension when you die from April 2027, and what they've confirmed is that for some people, the combined tax on your pension when you die could hit 67%. Not the headline rate, the real rate, and once you understand how the two tax events stack on top of each other, you're going to be shocked. So I'm going to show you exactly how that number works, what it means for your specific situation, and 5 actions you should take right now to protect what you built. To understand what's happened, we have to go back to 2015. Before then, if you died with money in your pension pot and your family wanted to inherit it, they faced a 55% tax charge on anything they took out. It was called the pension death tax. I know, lovely. At that rate, most people preferred annuities instead, where they'd give their pot for a guaranteed income for life, because leaving your pension pot to your children meant losing more than half of it to tax. George Osborne scrapped that charge in 2015 as part of his pension freedoms reforms, and overnight the picture completely changed. If you died before 75, your beneficiaries could inherit your entire pension pot with no tax at all. After 75, they'd pay income tax on withdrawals at their normal rate, but that 55% charge was gone. And here's what that change created. When you retire, you draw your pension down, and that seems fair. But sadly, most people will die before they've used it all. Maybe they went earlier than expected, maybe they had a few good years and hadn't got through it. Whatever the reason, there's money left in the pot. And people accepted that because they knew their money wouldn't be going to tax and it would be going to their family. And from 2015, the remainder passed to your children completely free of inheritance tax, outside of your estate entirely. The bigger your pot, the more likely you are to die with something left in it. And the financial planning industry quickly worked out that this made the pension one of the most tax-efficient ways to pass on money to the next generation. The pension had accidentally become the most powerful inheritance tax planning tool in the country, and the financial planning industry noticed. And for some people, this isn't small money. A couple with a £500,000 house, a decent pension pot, and some ISAs could suddenly find hundreds of thousands of pounds being dragged into inheritance tax that previously wouldn't have been touched at all. The government's own words from parliamentary petition response describe what follows as pensions being openly used and marketed as a tax planning vehicle to transfer wealth, rather than the way to fund retirement. And that's what they're now unwinding. The legislation is progressing through Parliament ahead of the planned April 2027 implementation, and HMRC now has published the technical note explaining how this is expected to work in practice. But before we get into these pension changes specifically, I want to show you something, because this doesn't exist in isolation. Inheritance tax receipts have now hit 5 consecutive record years. Last year alone, HMRC collected $8.5 billion, and the OBR forecasts that rising to $14.5 billion by 2030-31. And here's the thing about that number. It hasn't gone up because people are suddenly getting richer overnight. It's gone up because the threshold, the amount you can pass on before inheritance tax applies, has been frozen at £325,000 since 2009. That's 17 years. No increase while house prices have risen, investment portfolios have grown, and inflation has eroded the real value of that threshold every single year. If that £325,000 had kept pace with inflation since 2009, it would be around £500,000 today. And it isn't. It's still 325k, frozen until at least 2030. So more and more ordinary families are now inside of the inheritance tax net through no particular action of their own. They haven't done anything different, the world has just moved around them. And these thresholds will mean inheritance tax is no longer a tax reserved for the ultra wealthy. The number of ordinary families affected by inheritance tax will only grow in the coming years. Frozen thresholds are a tax rise by stealth. And the OBR, the Budget for Responsibility, forecasts that inheritance tax revenues will rise to $14.5 billion a year by 2030. That's a 67% increase in 5 years. And the amount I'm about to say, 6-7 in this video, no, that's not the 67% tax figure. That's coming next. Now, a big reason for this increase is in that environment, which is already pulling more estates in every year with the frozen thresholds and now rising asset prices like houses, the government is now adding pensions too. Yay. Pension tax relief currently costs the government $78.2 billion a year, and that's their own figure. They say they introduced that relief to encourage saving for retirement, not to pass on wealth inheritance tax free. And when Osborne's pension freedoms turned a pension into an inheritance tax shelter, the government decided that relief was no longer being used for its intended purposes. The change to inheritance tax on pension is expected to raise $5.46 billion for the Treasury over the next 4 years, so it's clear to see why they've targeted this. Until now, April 2027, pensions have largely sat outside of your estate for inheritance tax purposes for decades. The reason is structural because many pension death benefits have historically been handled using discretionary trust principles, meaning that the trustees decide who gets the death benefits. So technically, the asset never belonged to your estate, and that structure is what the inheritance tax exemption rested on, but now that's gone. From the 6th of April 2027, most unused defined contribution pension wealth, SIPs, workplace pensions, and personal pensions will be brought into scope for inheritance tax. The standard rate of inheritance tax is 40% on everything above your nil rate bands. So let's use a real example. You've got a house worth £300,000, £50,000 in ISAs, and a £400,000 defined contribution pension pot. If you're on a final salary scheme, this works differently, but for most people watching, this is your situation. So under the old rules, your estate for inheritance tax purposes is £350,000. The house and the ISAs, the pension sits completely outside of it. Your nil rate band is £325,000. And assuming you're leaving the house to your kids, you get the residence nil rate band of £175,000 too, so £500,000 in total. Your estate is £350,000, so you're under the threshold. Your inheritance tax bill is zero. Under the new rules, that same estate is £750,000. You have your 500k threshold still, but that leaves £250,000 taxable of 40%. Your bill is now £100,000, from zero to £100,000. The same family and the same assets, just a completely different set of rules. That's £100,000 your family doesn't get. Now, importantly, transfers between spouses and civil partners remain exempt from inheritance tax in most cases. So for many families, this becomes a bigger issue on second death or when assets are eventually passed down to children. This is actually one huge benefit of being married. HMRC's own figures say that of the 213,000 estates within pension wealth scope in the current year, only 10,500 will have a new inheritance tax liability. That's around 1.5% of total UK deaths. And for a lot of people watching this who own a home, your nil rate band may already be gone. Your house will fill it, which means your entire pension sits entirely above the threshold, all of it potentially taxable at 40%. The people most affected by this are the ones that did everything right. They built a serious pension, they own their home, and they have savings, and they just didn't game the system. They followed the rules, and the rules changed. But what the technical note actually confirmed is what your family has to go through to pay it, and some of this is genuinely new. So when you die, your family has 6 months to identify every pension you've ever had, get a valuation from each one, and pay the inheritance tax bill. Old workplace pension schemes, a SIP you opened years ago, a pension from a job you left in 2009, all of it. Finding pension pots has always been the hard part of settling an estate. What's new is why they're doing it. So before April 2027, finding an old pension meant releasing money to your family. Now after April 2027, it means a tax bill, and your family is personally on the hook for making sure HMRC gets paid. The pension scheme now has a formal 28-day window to respond to valuation requests. Before this, there was no specific deadline, which technically could make it a bit easier. But the inheritance tax bill is then due within 6 months of the date of death. 6 months while the family is grieving, while the estate is being settled, while they're chasing valuations from pension providers they've never even heard of. Experts at PensionBee have warned this could create a new administrative nightmare for grieving families, and HMRC's technical note demonstrates how technically demanding pension-related inheritance tax will be in practice. And here's something else from the technical note that's been confirmed, and this one cuts both ways. So under the new rules, your family can instruct the pension scheme to withhold up to 50% of the death benefits for up to 15 months while the inheritance tax is being sorted. The idea being that the money stays in the pension while the tax bill is being calculated and paid. The 50% that isn't withheld can be released to your beneficiaries in the meantime. Now on the surface, that sounds helpful, but think about what that actually means. Your children are grieving, they've been told their pension money is coming, and up to half of it can be legally held back for over a year while the paperwork is being sorted. They're not just waiting on the tax, they could be waiting on half of the money too. Some of this might sound good in practice, but the system to handle all of this, the calculations, the process maps, the guidance tools, HMRC has confirmed that there's still being being built. They've said that HMRC will continue to publish secondary legislation, guidance, and supporting materials ahead of the implementation in April 2027. They're building the system while the clock is already running. Now, before we move on, I want to show you something that I think is genuinely worth knowing about, especially if you're the kind of person that likes to keep a close eye on your money. It's called OpenClaw, hosted by Hostinger, and they've been kind enough to sponsor today's video. OpenClaw is really clever, and the simplest way to describe it is your own private AI assistant that actually does things, not just answer questions. So for example, you could set it up to pull live stock data and ETF prices, and then track your holdings and calculate your portfolio value automatically. You could tell it, alert me if this position drops 5%, or send me a daily summary every morning, and it handles all of that in the background, even when your laptop is closed. You can also pull in other data, things like crypto, broader market news, whatever you're tracking, and get a simple AI-generated summary rather than manually checking 5 different tabs. But what really makes Hostinger's version stand out is the setup. So normally getting something like this up and running would take hours, configuring servers, sorting API keys, and all of that. With Hostinger, it's genuinely one click. The hosting, the AI credits, and the web search tools all come bundled together. There's no separate accounts, no technical faff. It also connects to WhatsApp, Telegram, Slack, and Discord, so your assistant lives inside the apps you're already using every single day, which is so impressive. You can even have it send you a WhatsApp message with your stock updates or a market summary every single morning. Plans start from under £5.50 a month, and there's a 30-day money-back guarantee, so there's very little risk in trying it out. You can use the coupon code Chris Palmer to get an extra 10% on top of this too. Head to hostinger.com/Chris Palmer for more details, and I'll pop a QR code on screen and a link in the description down below too. So let's break down that 67% number that I mentioned at the start, and let me show you where this actually comes from. So the headline rate is 40%, but for a significant proportion of the people watching this video, the real number is much worse, and here's why. Pensions are subject to income tax on the way out, and when beneficiaries draw the money from an inherited pension, it counts as income and gets taxed at the marginal rate. And that's always been true for pensions inherited for someone who died after age 75. What changes from April is that pension also gets hit with inheritance tax first, before your beneficiaries even receive it. So there's 2 tax events, not one. And let me show you what this looks like in practice, because it's scary. So you die age 78 and you leave a pension worth £500,000 to your children outside of your bands. Step 1, inheritance tax at 40%. That's £200,000 straight to HMRC. Your children now have £300,000 left. Step 2, your children draw down that £300,000 because it came from a pension and you died after 75. And it's taxable income. At a higher rate, which more and more people are being dragged into because of fiscal drag, that's 40%. That's another £120,000 gone. They started with £500,000 and they end up with £180,000. That's an effective tax rate of 64%. If you're an additional ratepayer, that's 45% income tax. It rises to 67%. There's a parliamentary petition specifically about this double taxation issue. At the time of filming, it has over 25,000 signatures, and the title says it all. Stop the double tax, inheritance and income tax of pension funds and death benefits. The government's response was direct. They pointed to the £78.6 billion annual cost of pension tax relief, and they said that relief was designed to encourage saving for retirement and not to pass wealth on tax-free. And I can understand that argument. There were certain wealthy people building enormous pension pots with no intention of ever drawing them down. But here's the other side of this. The people most exposed to that 67% are not the ultra-wealthy. They have advisors who restructured everything years ago. The people sitting in this trap are the ones who followed the advice, mapped their workplace pension, built a serious pot, paid off the property, and they just planned to pass something on. They didn't exploit some kind of loophole, they just followed the advice. And the advice was right at the time, and now it isn't. Now, I know what the next question is. So if pensions are inside of your estate for inheritance tax, shouldn't you be putting that money into an ISA instead? And let me show you exactly how this changes the comparison. So before April next year, the pension had an inheritance tax advantage over the ISA. And now from April, that advantage is gone. So both are inside your estate. So the ISA should win, right? Well, not quite, because the pension still gives you tax relief on contributions. Basic rate taxpayer, every £80 you put in becomes £100, and the higher rate, that £80 costs you £60 after you claim the relief. That number hasn't changed, neither has the employer matching. That's still free money the ISA cannot compete with. What has changed is a strategy for drawing it down in retirement. So previously, the conventional wisdom was clear: draw the ISA first, preserve the pension as long as possible, and pass it on inheritance tax free. And that made complete sense, but now it doesn't. The logic is in reverse. So draw the pension first in retirement. You can take income tax hit on the way out, but reduce your taxable estate as you go. You can preserve your ISA because when your family inherits an ISA, withdrawals are tax-free. When they inherit a pension, withdrawals are taxable income on top of any inheritance tax already paid. If both are inside of your estate for inheritance tax anyway, you want the one that creates an additional income tax burden gone first. The pension is still the better wealth building vehicle, but the tax relief and employer contributions make it the right answer during accumulation. What's now changed is the exit strategy. The other question this raises is, well, what about trusts? A lot of people think the answer is simple, just use a trust. The problem is, according to HMRC's technical guidance, some of the most obvious structures people assume will work may not. Most pensions already use discretionary trust structures in the background, and that's actually part of the way they sat outside of your estate historically. But from April, that treatment changes. Even bypass trust arrangements, which many people assume could route around this, appear to still fall within the new rules. Now, trusts aren't useless, but it's far more complicated than a simple fix. One option, though, worth knowing about is a whole of life insurance written in trust. The payout sits outside of your estate, giving your family cash ready to cover the inheritance tax bill rather than scrambling to find it under the 6-month deadline. It doesn't avoid the tax, but it helps fund it. Now, the downside is the ongoing premium. Trusts are complicated though, and I recommend you getting proper advice. But there are 5 actions you can take today to help protect yourself. 1 is update your expression of wish form today. So every pension you have, old workplace scheme, your current employer, your SIP, log in and find the expression of wish or death benefit nomination form. Check that it's current and it names the right people. Under the new rules, the pension trustees need accurate beneficiaries information from day 1 of the process. Out-of-date forms cause delays. Delays will cost your family time and money at the worst possible moment. This costs nothing and it will take you minutes. Do it regardless of the size of your pot. Now, second is calculate your total estate. So out of your pensions, your ISAs, your property and savings, most people watching this have never actually done this. That number is the starting point for everything. Third is understate your nil rate bands. The standard band is £325,000. If you own your home and you're passing it on to direct descendants, the residence nil band adds £175,000. On a joint estate between spouses, you could combine both up to £1 million before inheritance tax applies, though it tapers above £2 million. So find out where does your number sit against those thresholds. Now, fourth is rethink your drawdown order. When you reach retirement, consider drawing your pension first and preserve your ISA. If both are inside your estate for inheritance tax purposes anyway, you want the one that creates an additional income tax burden on your beneficiaries reduced first. And importantly, don't let this change make you question pensions altogether. The tax relief hasn't changed, your employer contributions haven't changed, compounding hasn't changed. What changed is the exit strategy, not whether you build it. If you're years from retirement, make sure you start doing this stuff anyway because it's good to know now and get your actual numbers. Fifth is get proper advice if your estate is above the threshold. If your combined estate, pension, property and savings is above that nil rate bands and you haven't spoken to a regulated advisor about what that means, that conversation is overdue. Not because there's some kind of magic bullet that will solve all your problems, but because the situation is getting more complicated and getting it wrong can cost your family real money. The nil rate band has been frozen since 2009, while assets value have risen every single year. The inheritance tax is at a record $8.5 billion, and the OBR forecasting $14.5 billion by 2030. And now from April, your pension joined your estate for the first time. The government's argument is that pensions were being used as inheritance tax shelters rather than retirement vehicles, and there might be some truth in that, but the people involved in this aren't the ones that have gamed the system. They're the normal people who have followed the advice and been good with their money. The 40% headline rate is bad enough, but for additional rate taxpayer beneficiaries, a double taxation means an effective rate of 67%, and even that 63% for higher rate I think most people are going to fall into. This isn't a tax on the ultra wealthy, it's a tax on the people who did everything right. So make sure you update your expression of wish, know your number, keep contributing and rethink your drawdown order. Get some fixed fee advice if you need it. You spent decades building this and don't let the paperwork be the thing that undoes it. If you found this useful, please do subscribe and do me a favor and hit that like and hype button as it really helps push this video out and get it to as many people as possible. I'm halfway to building a £1 million portfolio on this channel and I'm sharing everything right here on this channel to show you how I'm doing it. And I'm also covering all this legislation that actually affects it and keeping you updated when the rules change. One last thing, and this is my personal take. As frustrating as this is, if you can pass on a combined £1 million to your family, that's still a remarkable thing to have built. The goal of your pension was always to fund your retirement and not your estate. So spend it, enjoy it, and help your kids while you're still still here and you can see them enjoying it. Junior ISAs, SIPs, gifting rules, you don't have to wait until you're gone. I think this will also push a lot of people towards strategies we haven't fully seen yet, maybe things like taking the pension overseas. But the one thing we do know for sure is that if these thresholds stay frozen, more ordinary families will get caught by this, not just super wealthy. And as ever, they will find a way around it. I hope you found this helpful. I've just posted an update on my portfolio so you can see how I'm doing, and I'll catch you guys over there. Thanks.